Hello guys, this is Abdul Rahman once again with you guys. So we will be discussing financial accounting. As in previous video, we discussed about the course outline. So now this time we will be moving to our first topic, which is like introduction to basic financial accounting. So let me share the PPTs with you. I guess it's visible to all of you. Okay. Now analyzing and recording transactions. This is will be like discussed later on. First, we will be just analyzing what the asset accounts are, what are liability accounts, what are revenue accounts. So we will be going through those. Okay, the first thing is system of accounts. Business transactions and events are the starting points of the financial statements. First of all, transactions are the events. Yeah, transactions that like events happen. After that, we record those transactions, and those transactions are then reflected in your financial statements. I guess it's okay with you guys. It's very simple, like basic thing. So there is a process from transaction to financial statements, like how transactions are reflected in your financial statements. So let's go through the process, which is first of all, we will identify each transaction in event from the source documents. As like every transactions will create a source document for you. From that source document, you can analyze or identify each transaction. After identifying, you can analyze each transaction. Okay. Later on, record the transaction, and then we will be like posting those general information to the ledger accounts. After ledger accounts, we will be like going for trial balance and financial statements. All right. Moving towards next slide. So, what kind of source documents are there? Those can be checks. Okay, employee earning records. Employee earning records can be like their work time. Okay, their record time, like how many hours they have worked, and we pay them according to their working hours. Okay, bills from supplier, like if we ordered anything or materials from supplier, like they will be making bill for that thing, bill of raw materials. Okay, purchase orders, these are the orders like that we will be, if we want to procure anything from our suppliers, we will be ordering them. We will be making a purchase order for them. Okay. Bank statements, sales tickets. Okay. These all are source documents from where we identify the event or transaction. Okay. Learning objective. Describe an account and its use in recording transaction. So the account and its analysis. An account is a record of increases and decreases in a specific asset, liability, equity, or revenue or expense. Okay. Then this account is like reflected in general ledger. The general ledger is a record of all accounts used by the company. Now, this is the basic accounting equation that you should always keep in your mind, as this is the base of accounting, financial accounting. Okay, you have to remember this equation all the time when making entries. Okay, general entries that we will be going through later. Asset is equal to liabilities plus equity. Okay, in assets there can be like cash, your assets, your fixed assets, your plant, property, equipment. Okay, there are different categories in assets account. We will be discussing it later. Liabilities are the, like you owe money to someone, you owe cash to someone. Okay, these are you owe services to some, like services are also owed. So remember this point as well. Then equity. Equity is the share of your shareholders. Okay, and excess earning that comes from revenue and difference expenses. Okay, that is also the part of equity account. Let's move ahead. Asset accounts. As I already told, like in few previous slides, There are different asset accounts. Those are like cash can be your asset. Cash is your asset, and actually, account receivable is your asset. Account receivables are like if you have given your services to someone, or if you have given your like product, or you have made the sale and you haven't received the payment yet. So it's account receivable. Note receivable is same as account receivable. It's difference. There's a difference between account receivable and note receivable. Account receivable is the account used when you are making or you are selling your product on credit. Okay. Note receivable is a account here you use when you are giving services to someone else. It's about service and product. Okay. This goes like hand by hand. Prepaid accounts. Prepaid accounts are your asset accounts once again. So prepaid is something like if you have paid for something for subscription or for your insurance in advance and you haven't received the service yet. So it's prepaid, okay? And prepaid is your asset because it will be giving you economic benefit in future. Supplies, office supplies, of course, those are your asset. Similarly, equipment, building, land. As we have seen the different types of assets, let me tell you one thing that will help you to like classify the things in asset accounts. Assets are something that are gonna provide you economic benefit in future. Remember this thing, economic benefit. Okay, if you think there is an commodity or anything that is gonna provide economic benefit in to you in future, then that's your asset. Okay, let's move to like liability accounts. These are liability accounts. Accounts payable, you have received the goods from your supplier or anyone, but you haven't paid them. Okay, you have to pay them in future. That's account payable. Notes payable is like again that product and service difference only. Accrued liabilities. Accrued liabilities can be your interest payable. Okay, you have taken the loan, you haven't paid the interest or the principal amount, the regular payments. Those are accrued liabilities. Accrued means it has incurred and you haven't paid it. Okay. Unearned revenue. I have taken the amount in advance for any service, but I haven't paid or given my services. Let me give you an example of airline. Suppose I am an airline, I have an airline business, or like I am an airline, okay? And someone has bought the ticket, okay, flight ticket, and they have paid in advance for the plane ticket as they haven't taken the service yet. So the amount I have taken will be like liability on me in terms of unearned revenue. Like I have to provide them service in near future. Okay, that's unearned revenue. Any amount you have taken and you haven't provided the service yet, that is your unearned revenue. You haven't earned it yet. You earn it when you will provide the service. Equity accounts. These are the equity accounts. Owners' withdrawals, owners' capital, revenues, expenses. Okay. These are direct accounts like owner's capital and owner's withdrawal. Any owner, he is investing his capital in the business. Okay. That's owner capital. And if and that will increase the equity accounts. Second is owner's withdrawal. If owner is taking out the money from his business, okay, in terms of withdrawals, if he is withdrawing anything, any asset or cash from business, that will reduce the equity. Okay. Then revenues and expenses. The difference of revenues and expenses goes to the equity account. Okay. In terms of retained earning. Later on, I will tell you what is retained earning. Okay, that is also the part of equity accounts. Now let's go beyond just specific things or basic things. We will be going on in detail later on. Okay, I guess three of the accounts are done. Uh, Now we are analyzing those accounts. Okay, the first is the revenues and owners' contributions increase equity. As I already told, higher the revenues. Okay, higher the revenues, and let's keep the expenses same. Revenues minus expenses is equal to retained earnings. Then those retained earnings will be greater when the revenues will increase. Okay. Expenses and owners withdrawal decrease equity. Expenses, as the expenses increases, if we see the equation, revenue minus expenses is equal to retained earnings. Expenses increases, retained earning decreases. Simple. Okay. Let's go ahead. Describe a ledger and chart of accounts. Now we are going from payments or transactions to or accounts to ledger. What is ledger? Ledger and chart of accounts. The ledger is a collection of all accounts for an accounting system. A company's size and diversity of operations affect the number of accounts needed. Yeah. Now ledger is like collection of all the account heads that the company is using. It depends on the like how big the company is, what are their operations, diversity of their operations. Like if they are simply trading in a bank, okay. In bank there will be their assets will be like reserves, okay, cash and the things like that, okay. The chart of accounts is a list of all accounts and includes an identifying number of each account. Okay, chart of accounts. Assets, liabilities, equity. So they have just segregated the accounts, their account head names as per assets, liabilities, and equity. Cash, account receivable, supplies, prepaid insurance, equipment. These are all asset, and we have discussed these all things. Liabilities, accounts payable, unearned, consulting revenue, and equity, teller capital. Teller capital means teller is the owner who has invested the capital in the business. Teller withdraws, it means teller has taken out some of his amount or in terms of cash or in terms of any asset from the business. Revenues and expenses. Revenues can be consulting revenue, rental revenue. It can be revenue from the sale of your goods. Okay. Expenses are like you are paying your employees whom you have hired and your business insurance expense, rent expense. These all are types of expenses. The difference between them goes directly into equity account in terms of retained earning. Okay, guys, like let's move to the next slide. Okay, so for right now, we have discussed like account segregation. Like you should have the identification of the account head. Like is it asset, is it liability or equity? This is a small quiz for you guys. You have to just identify which of these, like which of them are the like classified into assets, liabilities, and equity. Okay, take your time and like segregate these on your understanding of the best previous concepts. So first one is prepaid rent, owner capital. Prepaid rent, as I already told, prepaid rent, prepaid. It means you have already paid for something or any service that you haven't received yet. Okay. It means it is gonna provide you the future economic benefit. You will be receiving the service in future. So it's asset, as we already discussed. Okay. Prepaid, there's like key terms, there's a trick to always like that that will make your life easier. Prepaid, whenever it comes, take it like put it in asset category always. Receivable asset, payable liability, unearned liability. We already discussed very much in detail about unearned revenue. So I guess you all have segregated these in accounts, assets, liabilities, and equity accounts. So now let's move on. If you have any problem with this, you can ask me in the comment section. Okay. Now define debits and credits and explain double entry accounting. Okay. Double entry accounting, like just keep this thing in your mind, this word double entry. We will be discussing it when it comes to the entry part. Debit comes on the left side of account title or ledger or T account. Okay. Credit come on the right side. Okay. A T account represents a ledger account and is used to depict the effects of one or more transactions. This debit and credit will help us in the making of or recording of transactions, like how an account head behave. Like if the revenue is increasing, is it gonna increase the debit side or credit side? Okay, you have to understand these things. Okay, let's move. Debit, assets, expenses, drawing. Whenever these increases, they will be on debit side. Increase will always be debit for asset, expenses, and drawing. Credit, liabilities, revenues, capital. Whenever these will increase, they will be going to the credit side. So these arrow shows the increase in these accounts. Assets, yeah, as we discussed, the basic accounting equation. Assets is equal to liabilities plus equity. So for assets, I said whenever asset increases, it will be going on debit side. So debit for increases plus normal. Liabilities, credit for increases plus normal. Normal is the already balance of the debt accounted. Like asset will always be on the debit side. You can't find like the remaining account balance or the end balance on the credit side. End balance will be always on the left side. So equity, debit for decreases, credit for the increases, same as we already discussed for the liabilities. Here is how the double entry accounting system works. Here is the expanded accounting equation showing the equity section. Yeah, we said revenue minus expenses is equal to retained earning, and those retained earning are the part of equity account. Revenue minus expenses are the account heads in income statement, from where we get the net profit. The net profit goes from your income statement to the balance sheet and equity part. Okay, so here equity part is shown as a extended form. Owner's capital will increase equity. Owner's withdrawal, as this is the contra account of owner capital. If owner capital increases, it goes like credit. Okay. Second is owner withdrawals. Owner withdrawals are debit, right? Because it is a contra account. It will reduce your owner capital. So it is a debit. Similarly, revenues. Whenever a revenue increases, it will go on credit side. Whenever expense increases, it will go on the debit side. So at the end, for the profit, you will be getting a difference of these two accountants. An account balance is the difference between the increases and decreases in an account. Notice the T account. As I already told, the end balance is always the difference of debit and credit side. And for assets, you will find the end balance on the debit side. For liabilities, you will find the end balance on credit side. And for equity, you will find the end balance on credit side as well. So again, here's a quiz two for you guys. I just want you to guys to like tell in like where the end balances of these account heads will go. Like it will be debit or credit. The end balance will be debited or credit. Okay. Prepaid rent. Sorry. So prepaid rent. Already said. Prepaid rent is asset, no doubt, as we come from the quiz one part. Okay. Prepaid rent is an asset. An asset is always on the debit side. Is increase in asset goes in debit side. So it will be debit. Now let's see the land. Land. Okay. Land is also an asset. It will also be on the debit side. Owner withdrawals. Okay. Owner withdrawals. Owner's equity will always be on the credit side. But owner withdrawals is the contra account of owner's equity because it reduces the owner's equity. So it will be on debit side. Let's check. Assets increase debit normal, liabilities in credit normal, equity withdrawals expenses on debit side, investment revenues on credit side. So I we have discussed all these. I hope you have done good in this assignment. So we will be recording transactions and general post entries. We'll be discussing this thing in the next video. So stay connected. And if you have any question regarding the today's topic, you can ask directly to me in comment section. I will try to reply all of you guys and hope so you guys enjoyed the video. See you in next video.